We also have to look at yields. Yields have been the story of this morning so far. Taking a look at yields, when you look at the 30-year, it actually just kind of tipped across that 5% mark before the opening bell. Right now, we're actually seeing the 10-year at 4.5. It was a couple basis points higher. The 30-year pulling back below that 5% mark right now at 4.96. And really, that's where we have to start, Joe. The Moody's downgrade seeming to pop yields. They were much higher earlier, kind of easing back a bit right now. What's your make of the downgrade and the impact on the bond market?
I said last week, we talked about the equity market rebuilding bullish momentum and the fact that really sentiment and positioning didn't align with the very quick price recovery that we were witnessing. I said the risk was yields moving higher. And I really believe that the bond market got kind of caught leaning, if you would, almost where it picks off the equity rally. And the news over the weekend brings yields higher. We go up to, at 9:02 this morning, I think a 10-year got to 4.56. Now we see that yields have fallen back about 8 basis points, and equities find comfort in that. So I think the message for investors is this near-term bullish momentum of the last several weeks, it can continue if the bond market allows it. If yields do not rise significantly higher, if you don't see the 2-year break well above 4.1%, if you don't see a 30-year going towards 4.25%, then equities can continue the near-term bullish momentum. But I don't think any of us believes that that erases the fiscal challenge that we have in front of us that clearly has been highlighted since Fitch did the initial downgrade in 2011. S&P follows in 23, and here comes Moody. We don't have a perfect credit score anymore. JP Morgan's Jamie Dimon is talking about our debt to GDP right now. We've got a fiscal situation that at some point we are going to have to pay the price for in the equities market.
You know, speaking of Bank of America out with a note, Steve Weiss, Jason Snipe, I want to bounce this off of you. This is Bank of America on the Moody's downgrade earlier today. They said with tax cuts and tariffs hanging in the balance, Moody's appears to be sending a message that it thinks these policy changes will, on net, put the U.S. on an even worse fiscal trajectory. That is, tariff revenues won't fully offset the cost of the proposed tax bill. Bank of America goes on to say, we agree. Do you agree with Moody's and apparently Bank of America?
You know, I do. I mean, you got a $3.5 trillion addition to the deficit from the tax bill. Right now, if we continue to go as we have been going with these great, big, beautiful tariff deals, they're going to do really nothing to bolster our revenues, and definitely not meaningfully. So, look, it's I agree, but I'd also say this, that we've seen these downgrades before. Joe just quoted 2 of them. Where's the market versus those downgrades? The market's higher. So the U.S. debt is still the preferred debt in the world, whether it's AA1 or whether it's AAA, doesn't matter. Still the deepest market and most attractive debt. But that's not the only news that came out this weekend. And, you know, first of all, we had that very important proclamation from Donald Trump himself about Taylor Swift not being hot anymore. So that set off the market. And then you had the tariff, the trade agreement between the UK and EU, where we're strengthening our former trading partners in defense. Now, part of that's a good thing. The other thing is that maybe it's not so good. So overall, we continue to move forward with the chaos that we're seeing in the unsettling environment that I still think is dangerous for the U.S. And throw in the tax bill. And sure, that's going to drive some investment, but not until the trade issues are settled. So,
Jason Snipe,
momentum may die a little bit, but the market's also at a peak valuation.
So having some concerns about momentum. By the way, markets off of their lows of earlier as bond yields have
dramatically off their lows.
Jason, coming over to you. Do you agree with Bank of America, Moody's, the idea that we're on a worse fiscal trajectory and that there's more troubling signs ahead?
I would agree. I think, you know, in the long run, we can't continue to kick this ball down the road, you know, in my opinion. When I think about, as an example, in interest alone, we paid $1.1 trillion in interest alone on the federal debt last year. You know, what I will say with these 2 downgrades in the last 15 years, you know, we've had talks about American exceptionalism and all the concerns around that. sovereign nations have increased exposure in that time frame and doubled their holdings in that time frame and added $1.5 trillion in holdings since 2023, since the last downgrade. So for me, it is a fiscal problem. There's no doubt about that. But when we're talking about the markets and kind of concerns going forward, to Joe's point, I think the concern around yields and where they are, I think we are at an inflection point. The 10-year at 4.5%. The 30-year at 5% provides a formidable option away from equity. So that is something that I'm watching very closely in terms of the momentum with yields.
Yeah, I'm a buyer of 10 years. I mean, it is great while you're waiting out. I mean,
so you don't see the yield on the 10-year moving higher? Is that what you're saying? You want to buy at this point? I mean,
I want to buy some at this point. 4.5 is a great rate for a 10-year.
It's certainly a great rate, but I think a question for all three of you is House Speaker Johnson hopes to get that big, beautiful bill to a floor vote at some time this week. Does that equal a spike in yields on the bond market and potentially another sell-off in the equity market? Would you want to hold off on buying bonds until you see that reaction?
Look, I got crushed in the TLT. I've talked about that on air. Basically, 10-year level of around 4.30 was where I entered the TLT. I got out of it last week here, so I took about a 3% loss on it. I think the momentum right now points and positioning points towards higher yields, and you could fight against that very easily. And fundamentally, I agree with your perspective, Steve, but I think what's important in this entire conversation...
I'm not buying a whole position here, but it's a good place to start.
But I think what's important in this entire conversation is I think people hear about the U.S. losing its perfect credit rating, and they say, well, how could I buy stocks? Well, here's what you need to understand about buying stocks versus a fiscal position that continues to deteriorate. And, it's not just the present administration that this fiscal condition is deteriorated under. It's prior administrations as well, and no one seems to care. But it's about accessing the debt market, and who needs to access it? Does Microsoft really need to access? Do the Mag 7 really need to access the debt market? And I think that's important to understand. So you could have a stock market that continues to move higher because you have these mega cap trillion-dollar companies that don't need the debt market, but then underneath the surface, the consumer who's going out there and has to acquire a vehicle, whether they're leasing it or financing or tries to buy a home, that's the real economy. And I think that's where the continued challenge is going to be presenting itself in the coming years if you don't get the retreat in yields that this administration clearly wants.
It's undeniable you need to get the deficit under control. But the last two downgrades, borrowing costs spiked like they are right now, then they came back down. What's going to dictate ultimately where the yields go is the Fed and the economy. If the economy weakens, Fed's going to cut. So that's really what you have to watch for.
I just want to address Joe's point. Joe, I think the general point you're trying to make is that tech could be a safe haven during some of this volatility. These companies are less cost of capital sensitive, less interest rate sensitive. Steve Follett with a note. I'm just bringing this up here. We continue to expect sharply slowing U.S. core GDP and believe the tech is defensive narrative. That's at risk in the second half of 2025. And in all fairness, if we've seen some of this volatility, we have seen the tech trade unwind.
I don't think it's fair to. I don't know that anything's defensive. I think in reality, people think, look, in 2008, the world got a global margin call. Was anything defensive at that point? You were supposed to own assets that were uncorrelated, and basically everything went down. So I don't know that I buy that premise that it's defensive. My point is, just try and understand that you might be puzzled by a fiscal condition of the United States that doesn't look so good, and even the rest of the world, but yet equities continue to move higher, in particular these mega cap companies, because they don't need to access the capital. And Steve brings up a really good point. Ultimately, where you get the 10-year lower is because the consumer is pressured by the private sector borrowing costs. The demand from consumers begins to contract. And what does that lead to? That leads to an economic climate maybe doesn't look so good, and the Federal Reserve has to step in. So I guess the succinct way to say it is the stock market sometimes is not the economy, and I think this is a moment where you really need to see that play out, because I think it's somewhat puzzling to people that you're seeing equities remain high.
It's not the AA1, right? It's what the future is, right? Borrowing costs. You mentioned you're 4 or 5 last week, right? You're still at 4 or 5. So look, where companies can take the opportunity to stick at the consumer and say higher borrowing costs, they will, and improve their net interest margins, their spreads, financial institutions. But functionally, I think the impact is that it's another reason for the consumer to hunker down, as we've seen. And I think that's going to continue with the 2/3 of the economy.
All right, so a number of issues obviously facing the market. There's trade, there's tax policy, there's the deficit. Jason, I want to come over to you just talking more about the broader market. Canaccord out with a note earlier saying we would not be surprised to see a sideways market for the next 2 months with volatility gradually increasing as we approach mid-July tariff deadlines. Of course, that's referring to the quote-unquote reciprocal tariffs. That deadline ends on July the 9th. Is that something you agree with, that we may be on pace for kind of a sideways market during this time?
Definitely. I mean, we're 20% off the lows, I should say, in April. I mean, the market is now, the multiple on the market is 21.7 times. Prior to that, when Trump was elected, we were at the high at 22.7. So we're only, about a point off from that. And when I think about the catalyst going forward, the Fed is obviously out of the game now with delays on tariffs. So there's likely not going to be a move until later on this year. We're looking at earnings. Earnings have been revised downward. We're looking at this next quarter at about close to 6% earnings growth. A couple weeks ago it was over 10%. So for me, it is a kind of a trading range market for sure in the next few months. But as I kind of turn the page into later towards the end of the year and into next year, I think it also could be an accumulation phase.